Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Pacific Basin Shipping Limited annual report. Pacific Basin Shipping Limited offers a diverse range of services to the shipping industry. At its core, the company provides dry bulk shipping services that transport various commodities such as grains, ores, logs, and coal across international waters. In addition to shipping services, Pacific Basin also offers consulting, crewing, secretarial, and ship agency services to support its clients' needs. The company's expertise extends to vessel owning and chartering, allowing it to manage a fleet of 277 vessels, including Handysize, Capesize, and Supramax/Ultramax ships. Furthermore, Pacific Basin provides operation and management services, ensuring the smooth running of its vessels and meeting the demands of its clients. The company's comprehensive range of services makes it a one-stop shop for shipping companies and individuals seeking reliable and efficient solutions in the dry bulk shipping industry. Pacific Basin Shipping Limited market capitalization of $16 billion is materially smaller than most of its industry peers of roughly $39 billion. Pacific Basin Shipping Limited trades at a higher price-to-earnings ratio of 34 times and a higher price-to-book ratio of 1.09 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 24% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 3.97%. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be attributed to a few key factors. On the positive side, the core business has been performing well, with Handysize and Supramax daily TCE earnings outperforming the index by significant margins. Additionally, operating activity has increased by 32% year-on-year, contributing positively to revenue growth. Furthermore, share buybacks have also had a positive impact on revenue. However, there are also several factors that have led to revenue decline. The weaker freight market has been a major contributor, as well as the decrease in Handysize vessel days. Moreover, an increase in charter hire payments and non-capitalized charter costs have also negatively impacted revenue. These factors highlight the importance of monitoring and adapting to changes in the market to ensure sustained revenue growth. The net income of the company experienced a significant decline, decreasing by 56% from $131.7 million to $58.2 million over the given period. This substantial drop in net income is also reflected in the underlying profit, which decreased by 48.4% from $114.1 million to $59.2 million. The decrease in net income and underlying profit had a ripple effect on the company's profit margins. The net profit margin, which measures the percentage of revenue that falls to the bottom line, dropped from 5% to 3%. Additionally, the return on average equity, ROAE, another key profitability metric, decreased from 7% to 3%. These declines in profit margins indicate a decrease in the company's ability to generate profits from its operations. The company's financial performance indicates a consistent generation of positive operating cash flow. The data from various pages of the report confirms this trend. In 2025, the company generated $270.9 million in operating cash flow, while in 2024 it was $309.3 million. These figures demonstrate a steady increase in operating cash flow over the 2 years. The presence of positive operating cash flow is further supported by other metrics. The net cash generated from operating activities was also positive, with values of $270,906 and $309,335 in 2025 and 2024 respectively. Additionally, the total trade and other receivables were lower in 2025 compared to 2024, indicating that the company is able to collect its debts efficiently. The overall picture suggests that the company has a strong ability to generate cash from its operations, which is essential for its financial health and stability. This positive trend is likely to continue if the company's operational efficiency and revenue growth remain steady. The company's debt level and interest expenses have undergone significant changes over the past year. While there are discrepancies in the data, a general trend can be observed. In some instances, the total debt has decreased, such as on page 92 where it dropped from $238,424 to $135,676. However, other pages show an increase in total borrowings, like page 32, which saw a 48% rise from $527.9 million to $622 million. On the other hand, interest expenses have consistently decreased across various summaries. For example, on page 30, interest expenses dropped by 13% to $130, while on page 33 they fell by 22% from $17.8 million to $13.8 million. This downward trend is also reflected in pages 90 and 100, and 1, where net finance costs and interest expenses decreased by 13% and 11.3%, respectively. Overall, the data suggests that while there may be some inconsistencies in the debt level, interest expenses have generally decreased over the past year. Management is confident in the company's ability to deliver sustainable returns to shareholders despite changing market conditions. They aim to embed sustainability considerations into their business practices, prioritizing environmental, social, and governance (ESG) issues such as decarbonization regulations. The company remains committed to its core business in the Handysize and Supramax segments of the dry bulk sector, seeking to reduce earnings volatility through contracts of affreightment. Management is also assessing the financial implications of a new accounting standard that will come into effect in 2027. Overall, management's strategy focuses on long-term value creation, sustainability, and stability, with a commitment to delivering sustainable returns to shareholders while navigating changing market conditions. The company has made several strategic moves through acquisitions and divestitures. In terms of acquisitions, the company has purchased 4 Handysize new building vessels, with a total consideration of approximately $119.2 million to be delivered in the first half of 2028. Additionally, it acquired another set of 4 40,000 DWT Handysize newbuildings for an aggregate consideration of $119.2 million. Furthermore, the company has also acquired 4 64,000 DWT dual-fuel Ultramax newbuilding LEVs. On the other hand, the company has divested its older, fuel-inefficient, and smaller vessels as part of its strategic move to optimize its fleet. This decision is likely aimed at improving operational efficiency and reducing costs associated with maintaining an aging fleet. By shedding these vessels, the company can focus on newer, more efficient ships that align with its business goals and environmental commitments. The company has a history of paying dividends and buying back shares. In terms of dividend payments, the company has confirmed that it has indeed paid out dividends in the past, with specific amounts mentioned for the year 2025. The company's dividend policy is to pay out at least 50% of its net profit, excluding vessel disposal gains, from 2026 onwards. Regarding share buybacks, the company has also engaged in this practice. According to the provided information, the company bought back a significant number of shares, with approximately 150 million shares repurchased for an aggregate consideration of around $311 million. This indicates that the company has been actively managing its capital structure through share buybacks. That concludes the financial summary for Pacific Basin Shipping Limited. Feel free to comment below, and I will be happy to answer them when possible.